we are witnessing a physical re-engineering of the American landscape. I mean, it's arguably the most profound infrastructure build-out since, what, the original highway system?
Or the electrification of the 20th century, for sure. You just have to look around.
Exactly. The existing electrical grid is just, it's screaming under the strain of these new AI data centers.
Oh, yeah. They demand staggering amounts of power, gigawatts.
And at the same time, you've got fiber optics being laid under our roads at this dizzying pace. High-voltage transmission lines are being rebuilt, sometimes buried completely, to guard against climate risks.
It's true. The investment world gets so captivated by the ephemeral stuff, the software, the chips, the algorithms.
Right.
But those digital dreams, they rely entirely on a deep physical reality.
Someone has to actually do the work.
Someone has to move the steel, the diesel, the cement, and the dirt to make it all possible. We're talking about an immense amount of heavy civil work. So the central question for us and for you, the investor, is who are the giants quietly building this future?
And more importantly, can we find a business model that's, structurally designed to profit from this multi-decade transformation? Today, we are undertaking a major deep dive into one of the largest and most critical infrastructure contractors out there, MasTec, Inc., ticker MTZ. As of today, that's November 30th, 2025, the stock is trading at $213.88.
And that price, that $213.88, immediately sets the stage for our entire analysis. Because when we run the numbers, when we apply a conservative, modernized value investing framework, our intrinsic valuation model suggests a base case value closer to $185.
Wow. Okay, so that is a significant gap. What is that, like 15%?
It's a big gap, and it tells us one thing very clearly.
What's that?
The market is absolutely pricing for perfection.
Okay, so it's anticipating flawless execution, double-digit growth, margin expansion for years to come.
Exactly. It forces us to address this core dilemma.
Which is MasTec a durable long-term compounder set to just run for decades on the strength of this infrastructure supercycle?
Yep. Or is it a high-beta cyclical construction company caught at a peak valuation, just waiting for the first economic hiccup?
Or the first execution stumble, or maybe the next tariff threat.
To just crash that premium multiple the market is giving it right now.
So our mission today is to anchor our analysis firmly to the data as of November 30, 2025. We're going to methodically dissect MasTec's highly diversified business model.
Right.
Rigorously evaluate the management team, the Mas family behind this staggering growth, scrutinize its financial health and its capacity for compounding.
And crucially, we're going to lay out the significant execution and macro risks that must be navigated to justify that $213 price tag.
So let's start by unpacking the segments that generate the, over $14 billion in revenue MasTec expects in 2025.
That's the number. Let's dive in.
Part 1, Chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding.
Okay, let's start at the very foundation. MasTec's core identity is that of the silent partner. They're the premier execution arm for the digital and energy transition across North America.
They're the definition of a heavy civil contractor.
They are. They don't innovate new technology. They simply execute projects that require massive scale, specialized equipment, and skilled labor.
As we said, they scale with steel, diesel, and sweat.
Right, which is a powerful differentiator from all those asset-light tech firms that get the headlines.
And understanding their revenue streams is just, it's so key.
Yeah.
Because it hedges against that natural cyclicality of construction, right?
Absolutely. They have wisely diversified into 4 major segments, which all operate under one massive corporate umbrella.
So how do these contracts typically work? What are we looking at?
Their fundamental revenue model involves project execution using 2 primary contract types. First, you have your fixed price bids.
Okay, that sounds like where MasTec takes on the most risk.
That's it. They quote a price, and if inflation or unexpected delays happen, they eat the overrun.
High risk, high reward, I guess?
Exactly. These contracts offer the highest potential margin, but they're also the riskiest, which we saw play out during that 2023 inflation spike.
Ouch. Okay, so what's the other type?
Second, and this is what management increasingly favors now, are cost-plus arrangements.
So the client agrees to pay all the costs plus a guaranteed profit margin on top.
Right. They're just safer. They're much more insulated from those macro risks.
Okay, so let's break down the 4 segments. We'll start with communications. That's historically been the bedrock of the company, right?
It has. The communications segment is all driven by bandwidth demand. This involves the physical deployment of telecom infrastructure.
And it's not just the old cell towers anymore.
No. Crucially, this segment is moving beyond just traditional cell towers into 5G small cells, the smaller nodes needed for dense urban coverage.
Right.
But the real driver here, backed by massive federal funding, is fiber to the home, or FTTH.
So they are literally digging up neighborhoods to lay high-speed fiber optic cables.
Literally. And they're benefiting significantly from government initiatives like the Rural Digital Opportunity Fund, RDOF, that provides a predictable, long-term pipeline of work.
Okay, then we shift to what you called the engine of future growth, clean energy and infrastructure. This is where that post-2022 strategy really comes into play.
This segment is it's ground zero for the IRA, the Inflation Reduction Act tailwinds, the massive 2022 acquisition of IEA, which we'll get into.
Okay.
That brought specialized vertical integration into renewables. So MasTec now handles the full life cycle of renewable projects.
What does that mean, full life cycle?
It means everything. Building access roads, grading the sites, pouring foundations for wind turbines, installing these vast solar farms, and setting up the complex infrastructure for battery energy storage systems, or BSS.
Ah.
And importantly, this segment also includes steady counter-cyclical revenue from heavy civil construction bridges, roads, water, which is often funded by state and federal infrastructure bills.
Right, so you can't generate all that solar and wind power without moving it somewhere.
Yeah, exactly.
And that leads directly to the third segment, which is just exploding demand right now, power delivery.
This segment is the most exposed in a good way to the current AI power crunch.
So what are they building here?
MasTec is focused on building and upgrading the electrical backbone. So high voltage transmission lines, which are like the highways of power, and then the local distribution systems.
And they're involved in grid hardening, too.
Very involved. That's making the grid resilient against extreme weather, which is just non-negotiable for utilities now. And this segment is high margin.
Why is it high margin?
Because of the specialized emergency restoration services.
So when a hurricane or a wildfire knocks out power.
MasTec can dispatch crews at premium rates under existing contracts. It's a fantastic operational hedge against downtime.
Okay. And finally, the pipeline infrastructure segment. This used to be the dominant oil and gas division, but it's been intentionally right-sized.
Correct. Management was very wise to slim this down. While they still do maintenance and upgrades on existing oil and gas pipelines, the strategic pivot is toward new energy pipelines.
New energy. So what does that entail?
We're talking about projects centered on carbon capture, utilization, and storage CCUS and hydrogen transport.
So it allows them to repurpose all their specialized pipeline equipment and expertise for the energy transition.
Exactly. They're aligning it with where the world is headed.
Okay, so MasTec's products are really outcomes. They're functioning assets. You mentioned they delivered two main types of service, turnkey construction and maintenance. Can you elaborate on that?
Sure. Turnkey construction often falls under what's called EPC, contracts, engineering, procurement, and construction.
This is where MasTec is most involved.
The most involved. They take ownership of everything from the initial engineering blueprints to procuring all the materials, steel, cables, solar panels, and then managing the construction and final connection. It's a massive logistical undertaking.
High risk, high reward. We talked about that.
We did. And the counterweight to that is the maintenance and upgrade services. These are covered by long-term master service agreements, or MSAs.
So once a transmission line is built, it needs to be looked after.
For its entire 50-year life, it requires constant inspection, repair, upgrades. These MSAs provide predictable, high-margin, recurring revenue.
And that acts as a crucial stability buffer against the lumpy nature of those big EPC projects?
It does. That recurring revenue stream is a major reason the market gives them a premium valuation.
Let's talk scale, because in this sector, scale is the barrier to entry. We're talking a $16.34 billion market cap giant. Expected 2025 revenue is over $14 billion.
Huge numbers.
But the most compelling metric for investors looking for stability has to be the backlog.
The backlog is phenomenal. MasTec reported a record 18-month backlog of $16.8 billion.
So they have more contracted, committed work lined up than their entire projected annual revenue.
That's right. For a cyclical construction company, that kind of revenue visibility, basically having over a year's worth of work guaranteed, is an immense de-risking factor. It just validates the current demand environment.
So here's the core question for a value investor. Why do massive, sophisticated clients like a big utility or a telecom giant, Why do they choose MasTec and pay a premium instead of just managing the construction themselves to save money?
It really boils down to three core competencies that form their competitive moat.
Okay.
First is risk transfer. Building a massive solar farm or a transcontinental pipeline is just fraught with risks.
Oh, yeah. Local permitting nightmares, labor disputes.
Material shortages, or just plain bad weather. Clients view MasTec as an insurance policy. They pay a premium to offload all that execution chaos to MasTec, securing a fixed timeline and a fixed budget.
And the second pillar is financial, and this is where a lot of smaller firms just fail. Bonding capacity. You said this is a critical moat.
It really, really is. Think of bonding capacity as a massive corporate insurance policy that's backed by MasTec's pristine balance sheet.
How does that work?
Large clients require performance bonds. These are legal guarantees that MasTec will finish the project even if they go bankrupt or fail. Because MasTec is so financially robust, they can secure billions in these bonds.
And a smaller regional competitor
Simply cannot get that financing no matter how good their crews are. This financial moat instantly locks out, I'd say, 90% of the competition.
Wow. And the third pillar is that national footprint.
This is key for the big national programs. Imagine a major tech company deciding to build 7 new massive data centers across 7 different states.
They don't want 7 different contractors.
Exactly. They don't want to manage 7 contracts, 7 sets of safety standards. MasTec provides 1 point of accountability, 1 standard of safety, 1 integrated supply chain manager for the whole program. It simplifies logistics for the client tremendously.
Let's zero in on the industry drivers. We keep hearing this word supercycle. What specific forces are driving this unprecedented demand in 2025?
You've got 3 converging tailwinds. First and foremost, the AI power crunch. AI isn't just software, it's hardware that needs constant, massive power. Data center demand is, it's fundamentally decoupling electricity usage from economic growth. It's growing exponentially.
And MasTec is the primary builder of the grid interconnects and substations needed to plug these things in.
Correct. And second, you have the mandatory upgrades to the existing fragile system.
Grid modernization.
Right. The average age of components in the U.S. electrical grid is decades old. The mandatory push for resilience grid hardening, burying lines in high-risk zones, digitizing power flow, it's a non-cyclical, multi-decade necessity.
The utilities have no choice.
They have no choice but to spend billions. And finally, the regulatory push, mainly from the IRA, continues to deploy renewable energy, which MTZ captures from generation all the way through transmission.
Okay, shifting the competition. We said that the structure is an oligopoly at the top. Their main rival is Quanta Services, ticker PWR. What's the benchmark Quanta sets that MasTec is trying to catch?
Quanta is generally seen as the bigger, broader industry leader, especially in electric power infrastructure. They set the financial benchmark.
Which is?
Consistent EBITDA margins of 10% to 12%. Because of that dominance and efficiency, Quanta historically commands a higher premium valuation than MasTec.
So MasTec is basically playing catch-up.
They are, and they're leveraging their recent acquisitions to close that margin and scale gap. Below these 2 giants, the market just fragments into specialized rivals like Dycom in telecom or EMCR in mechanical.
So if MasTec is competing against this swarm of regional firms below them, how do they maintain their moats? We talked about capital and bonding, but what about safety and labor?
The safety record is a subtle but it's an ironclad moat. Utilities are regulated and extremely liability averse.
Right.
They will not entrust a billion-dollar project to a firm without an impeccable total recordable incident rate, or TRIR, history. Building that safety track record takes decades and hundreds of millions in investment. A new firm can't fake that.
And the skilled labor issue is?
Yeah.
It's everywhere right now, but it must be acute in heavy civil.
Absolutely. We are talking about highly specialized, often unionized trades, certified line workers, specialized drill operators, welding experts. The average age of these workers is high, the talent pipeline is thin.
So how does MasTec tackle that?
They run their own internal training schools and invest heavily in retention and recruitment. This ability to reliably source and deploy thousands of skilled workers nationally is a huge competitive barrier that limits the growth of smaller players.
Okay, finally, what is MasTec's unique capability that makes it stand out even from Quanta? You called it the one-stop shop model and the traveling circus. Let's make that vivid.
The one-stop shop is all about integration. A client building a utility-scale solar facility might need 5 or 6 different types of construction services.
Earthwork, foundations, electrical.
Exactly. Civil earthwork, foundation pouring, electrical component installation, substation construction, transmission line hookup. Most competitors only do 1 or 2 of those things.
But MasTec does all of them through their segments.
All four. They can execute the entire project end-to-end, which simplifies the client's life and lets MasTec capture all the margin that would normally be split among multiple contractors.
And the traveling circus, I love that term.
That's how they maximize their massive capital investment. Imagine they have say, a $5 million specialized directional drilling rig needed for a 6-month telecom job in California.
Okay.
Once that job is done, if they were a regional firm, that rig might sit idle for 3 months waiting for the next local job.
Right, just burning cash.
But MasTec immediately redeploys that rig across the country, say, to a high-voltage transmission job in Texas, using their national asset management system. They keep their high-cost equipment in constant use, maximizing utilization rates and driving down their operational costs.
So they achieve superior economies of scale.
That's the game.
That paints a powerful picture of operational efficiency. Let's move to the people who are guiding this machine.
Chapter 2. Management Evaluation.
So we're looking at a classic example of a founder-led public company with a dynasty structure, the Mas family. Jose Mas has been CEO since 2007, and his brother, Jorge Mas, is the chairman. How do you assess the leadership quality here?
The assessment is high. I mean, it's primarily because Jose Mas is a field-tested operator. He didn't just step into the role. He grew up in the business, learning the complexity of execution right there on the ground.
And the numbers back that up.
The headline metric of his tenure is just staggering. He took the company from less than $1 billion in revenue in 2007 to an expected $14 billion in 2025.
A 16% compound annual growth rate over nearly 2 decades.
Yeah.
That's phenomenal for a capital-intensive, low-margin industry.
It's incredible.
But let's break down that CJ war. How much of that was pure organic growth versus growth that was driven by M&A roll-ups?
The growth has always been a strategic blend. The early years focused on targeted regional acquisitions to gain, geographical reach and specialized capabilities like deep experience in pipeline or communications.
And that created the initial scale.
Right. And the recent growth, that 14% organic growth expected in 2025, that's the payoff of those earlier strategic acquisitions. It proves the integration is finally bearing fruit, and it's now being amplified by the supercycle tailwinds.
So it's long-term planning, not just opportunistic buying.
Exactly.
But even great management teams hit walls. MasTec faced a brutal test in 2023, a financial and operational perfect storm. Let's revisit that crisis, because the response is the true measure of management quality.
Yeah. The 2023 period was characterized by 3 simultaneous negative pressures. First, severe inflation just destroyed the profitability of the fixed-price contracts they held.
Which were priced before costs for steel and labor soared.
Right. Second, they stumbled hard on integrating that massive IEA acquisition, which came with low-margin legacy contracts that dragged down company-wide profitability.
And third,
they faced unprecedented permitting gridlock. Projects were signed but couldn't start, which meant idling crews and crushing their asset utilization. The stock collapsed.
So what was Jose Mas's specific response? Did he hide behind macro factors, or did he take accountability?
Oh, he took clear public accountability. He specifically addressed the unclean backlog inherited from IEA and the failure to hedge inflation risk effectively on those older contracts.
And the turnaround strategy.
It was rigorous and transparent. They immediately ceased M&A activity to focus 100% on operational integration. They aggressively pivoted new business away from risky fixed-price bids toward safer cost-plus arrangements to insulate their margins. And crucially, they made debt reduction their non-negotiable priority.
And the stock's recovery to over $213 in late 2025 is the market validating that this turnaround plan is working.
It is.
But let's challenge that. Isn't there a risk that by pivoting almost entirely to safer cost-plus contracts, they're foregoing the massive margin upside that's available in fixed-price bids, especially now that inflation is moderating?
That is a very legitimate strategic risk. They are absolutely prioritizing consistency and stability, what we call margin sanity, over margin potential.
Well, they're playing it safe.
For now, yes. Given the disaster of 2023, management clearly values predictability. They're telling the market they prefer 8% to 9% EBITDA margins they can guarantee, rather than chasing 12% margins that could quickly turn into 2% losses if input costs spike again.
And that lowers the overall risk profile of the business,
which the market seems to appreciate right now.
Let's discuss capital allocation. They are self-described as a serial acquirer. Has that M&A focus ended?
For now, yes. Post-IEA, the strategy has emphatically shifted from empire building, acquiring more firms, to harvesting the cash flows from the assets they already own.
That IEA acquisition was controversial at the time.
Very, but it looks prescient now, positioning them perfectly for the IRA. Currently, every dollar generated is prioritized for operational improvement and debt reduction, not new deals.
And this commitment to being a growth compounder is reflected in their shareholder returns. They pay 0 dividends.
That's right. The philosophy is pure growth. Capital is better reinvested into buying more specialized equipment, training more skilled labor, and driving organic expansion rather than being returned to shareholders today.
And they treat share buybacks as a value arbitrage tool.
Purely.
Can you give us an example of this opportunistic buyback strategy?
Absolutely. They authorized a significant $150 million repurchase program during the COVID-19 panic in 2020 when the stock was heavily depressed.
Buying back shares cheaply when capital was scarce. Smart.
Very. And more recently, in Q1 2025, even as the stock was recovering, they spent another $37 million on buybacks.
Which confirms that management views the stock price as a key metric, and they'll use excess capital to shrink the share count when they believe the market price is too low.
It signals strong internal confidence.
The ultimate measure of internal success for any capital-intensive business is return on invested capital, or ROIC. This measures how effectively they turn debt and equity into profit. Where does MasTec stand?
Historically, their ROIC has hovered between 8% and 12%, which is respectable for this sector. It took a major hit in 2023 as the asset base swelled post-IEA and margins compressed.
But the critical insight is whether their ROIC is higher than their weighted average cost of capital, their WACC.
That's the key. We estimate their WACC, the cost of borrowing in equity, to be around 8% to 9%.
So as long as the ROIC is consistently above that 8% or 9% level, they are creating true economic value. What's the current trajectory?
The current trajectory is excellent. By achieving a standout adjusted EBITDA margin of 9.4% in Q3 2025 and focusing on asset utilization, that traveling circus model, they are demonstrating that ROIC is trending above WACC.
So every dollar they invest back into the business is generating returns higher than the cost of that capital.
That is the definition of a compounder.
Okay, finally, let's discuss the governance and transparency that come with a family business ethos.
On the transparency front, they are generally highly regarded. They provide detailed financial reporting, sophisticated earnings bridges to explain complex variances. But the governance consideration is the key man dynamic created by the family's concentrated voting power. This ensures a stable, long-term vision, but it means minority shareholders have limited influence.
So if the Mas family decides on a major controversial strategic direction, like a return to large-scale M&A, it would be very difficult for institutional shareholders to block it.
Very difficult.
That's a risk we have to weigh against the clear alignment of interest, given the family holds over 21% of the company. Let's shift our focus now to the raw numbers that underpin our valuation.
Chapter 3. Financial health.
Okay, let's get into the key financial trajectory. The 5-year revenue trend has been impressive, but 2025 looks like an outlier, showing a really sharp acceleration.
It is. After consolidating around $12.3 billion in revenue in 2024, the full-year estimate for 2025 is projected to be over $14 billion.
That represents about 14% organic growth.
Which is huge. That growth is not coming from buying new companies. It's coming from executing on the existing massive backlog, specifically in those high-demand power delivery and clean energy segments. In construction, 14% organic growth at this scale is it's explosive.
And in this business, margin is everything. A single percentage point fluctuation can wipe out profits entirely. So what are the key margin metrics we need to be tracking?
The gross margin tends to be stable, around 14% to 16%, but the performance indicator Wall Street watches most closely is the adjusted EBITDA margin.
Right.
After that disastrous dip to 7% in 2023, the turnaround has been focused on margin expansion. Management is targeting 8.1% to 8.3% for the full year 2025, which is already a significant improvement.
But what really caught the market's attention was the Q3 result.
The Q3 2025 result, 9.4% EBITDA margin.
And hitting 9.4% is critical because it signals genuine pricing power and execution efficiency. It suggests they're successfully isolating their margins from input cost volatility.
Exactly. It validates the pivot toward cost-plus contracts and proves they are tightening operational slack across the organization. For a heavy civil contractor, a net margin around 4.2%, which they achieved in Q3, is very healthy and confirms strong operating leverage.
Let's discuss free cash flow, FCF, because our intrinsic valuation hinges on this. You mentioned FCF is notoriously lumpy in this business. We need to explain why that happens.
Okay, the lumpiness is all dictated by the working capital cycle. Think about building a massive substation. MasTec first has huge cash outflows.
Right, they have to pay their crews every week. They have to buy the steel, the transformers.
We have to pay for all that up front.
Yeah.
This consumes cash. Only later, maybe months later, do they hit a contractual milestone, and the client sends that large lump sum inflow payment.
So when a company like MasTec is growing rapidly, like 14% in 2025, that rapid growth is actually a massive drain on cash in the short term, even if the business is healthy.
Precisely. They were consuming cash to fund the growth and the materials needed for that $14 billion in revenue. We saw a record FCF of over $1 billion in 2024.
$1 billion. Wow.
But that was driven by management aggressively collecting overdue receivables and focusing solely on deleveraging. In 2025, year-to-date, FCF moderated sharply to just $35.6 million.
And that's to be expected.
It's expected. It confirms cash is being poured back into the ground to facilitate that rapid revenue acceleration. It's a sign of a high-working, capital-intensive business in a growth cycle.
Let's look at the balance sheet. Deleveraging was management's stated priority. Did they succeed in strengthening liquidity?
Absolutely. They brought the net debt to EBITDA ratio down from a high of around 3.0x to a much more comfortable 1.8x by the end of 2024.
So the debt load is manageable.
It is. And the business is not structurally dependent on refinancing debt. Overall liquidity is robust. You've got a debt-to-equity ratio of 0.69 and a current ratio of 1.33. That means they have a significant buffer of liquid assets to cover any short-term operational crunches.
Okay, time for the ultimate financial check, valuation analysis. Let's start with relative valuation. At the current price of $213.88 and projected 2025 EPS of $6.40, the forward PE ratio is, what, about 33.4 times?
That number, 33.4x, is genuinely startling if you adhere to old valuation norms. Historically, general engineering and construction firms were valued purely cyclically. They traded at a PE multiple between 10x and 15x.
So this massive re-rating is the infrastructure premium at work.
It is.
Let's elaborate on this premium. Why is the market willing to pay tech-like multiples 33 times earnings for a company that digs trenches and installs steel?
It's because the market no longer views MasTec as a general construction firm that relies on the business cycle.
Right.
It views them as a secular growth vehicle, a pure-play bet on the non-negotiable multi-decade transformation of the grid and digital infrastructure. Investors believe the demand from AI, grid hardening, and renewables is effectively infinite and decoupled from short-term GDP fluctuations.
So they're pricing in perpetual high-margin growth, similar to the multiples awarded to other infrastructure compounders like Quanta.
That's the story.
But we need to strip away that sentiment and arrive at the intrinsic value. We used a discounted cash flow model, a DCF, which calculates what those future cash flows are worth today. What were the core assumptions in our DCF?
We aimed for realism. We had to normalize the highly volatile FCF for 2026, so we settled on a conservative baseline of $600 million. We assumed a WACC of 8.5%. And crucially, we assumed a 12% annual free cash flow growth rate for the first 5 years, dropping to a perpetual growth rate of 3% after that.
Let's pause on that 12% FCF growth assumption. You established they're projected for 14% revenue growth in 2025. Is 12% FCF growth realistic given how cash-consumptive rapid growth is? That feels aggressive for a construction firm.
It is aggressive, and that's the point where we have to test the assumption. It's only justified if MasTec maintains that high 9% plus EBITDA margin and significantly improves its working capital management, getting faster at collecting those milestone payments.
So if they slip back to 8% margins or if receivables balloon, that 12% target collapses.
It collapses quickly. The DCF is built on the optimistic premise that management executes flawlessly on margin expansion and cash collection.
Okay, so based on those aggressive but, achievable assumptions, 12% FCF growth discounted at 8.5% WACC, what was the result? What did the DCF calculate?
The implied intrinsic share price came out to approximately $185 per share.
And that brings us right back to the gap we started with. Market price at $213.88, DCF value at $185. That $28 difference is pure optimism.
It is.
So what specific execution metrics does MasTec have to hit to close that gap and justify the $213 price?
To justify $213.88, the market is effectively baking in sustained FCF growth closer to 15% to 18% annually, or maintaining EBITDA margins above 10%, the benchmark set by Quanta consistently for the next 3 years.
So if MasTec falters at all, if the turnaround stalls or they suffer an operational hiccup?
That premium multiple will contract rapidly, bringing the price back toward our $185 baseline. For investors buying at $213, there is virtually zero margin of safety.
That analysis provides a crucial pivot point. We've established the quality of the business and the aggressive nature of the current valuation. Before we pivot to how the market sees this story, let's take a quick moment.
If you are finding this level of detail valuable and you want to continue accessing rigorous analysis like this on the biggest names in the market, please
Like and subscribe to Stock Analytics AI.
We currently offer over 500 deep dive videos covering every S&P 500 stock, with the NASDAQ 100 roster coming next, plus members-only requested deep dives.
For $4.99 a month, you get full access to the videos and our complete analytical framework. Now let's explore who is buying the stock and why Wall Street is so convinced that MasTec is headed even higher. Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
Okay, so following that powerful recovery from the 2023 trough, the current sentiment surrounding MasTec is it's overwhelmingly bullish. The analyst consensus from covering banks is currently a strong buy. The average 12-month price target is approximately $248.50, which suggests a significant upside from the current price. Some firms have targets well into the high $200.
A $248 average target is compelling, but you flagged a fascinating disconnect within that data. The stock is actually trading below the lowest official price target. What does that mean?
It's a remarkable insight into market dynamics. The lowest analyst price target currently sits at $225.
And the stock is at $213.88.
So the broader investing public, the trading floor, the institutional algorithms are exhibiting a caution that the sector-specific analysts are not.
So what does that suggest?
It suggests either general macro fears like concern over interest rates or geopolitics are suppressing the price, or that the market just hasn't fully digested the latest earnings reports, even while the experts covering the company daily remain universally optimistic. It's a sign of lingering, perhaps irrational, anxiety.
And the media narrative has clearly shifted. We moved from MasTec is collapsing under debt in 2023 to MasTec is the prime pick and shovel play for AI in 2025.
The narrative change is complete. The investment story is now entirely focused on the secular, non-cyclical nature of their backlog. That Q3 2025 earnings report, which highlighted 22% organic revenue growth and those expanded margins, that served as the primary catalyst to cement this positive narrative. It silenced the debt bears and confirmed the long-term infrastructure supercycle thesis.
Let's look at the positioning from investors trying to bet against this momentum. What does the short interest data tell us?
Short interest is minimal. It's sitting at a very low 2.72% of the floating shares.
And anything below 3% is basically nothing.
It suggests a broad market consensus that the stock is not fundamentally overvalued at this price, despite our DCF showing that gap. There's no potential for a short squeeze here, but critically, there is also minimal organized bearish pushback.
So few funds are willing to bet against those massive secular tailwinds. From a technical perspective, the stock is showing clear momentum, right?
Absolutely. The stock is trading comfortably above both its 50-day and 200-day moving averages, a classic golden cross configuration that confirms a powerful, sustained uptrend. But technical analysts would caution that the significant gap between the current price and the 200-day average indicates the stock is technically overbought in the short term.
So it's vulnerable to a sharp short-term correction.
Or a mean reversion pullback, which aligns perfectly with our wait for a pullback investment thesis.
Okay, let's drill down into who actually holds these shares.
Chapter 5, ownership structure. Institutional ownership is very high. It's standing at 75.7%. The passive giants BlackRock with about 10% and Vanguard with 7.7% dominate the shareholder register.
Which is pretty standard for a company of this size. It provides price stability, but also ties the stock's performance to the broader indices.
It does. We also note the presence of specialized active funds, which shows that sophisticated investors are validating the specific energy transition story.
But the truly distinctive feature of MasTec is that concentrated insider ownership, the Mas family. They hold an unusually high 21.4% of outstanding shares. What's the fundamental implication of that?
The implication is massive.
Mhm.
It means MasTec operates as a public company, but is run with a private, long-term mindset.
So they don't have to chase quarterly earnings or bend to activist demands.
Not at all. The Mas family's net worth is intrinsically linked to the stock's performance decades into the future. This creates a powerful alignment of interest with the long-term shareholders who are betting on the infrastructure supercycle.
That stability and alignment are a major positive. But what does management's recent transaction data tell us about their perception of the stock's current value?
This is a key insight. The data shows insiders selling over the past year totaling about $4.8 million.
Okay.
And while this is routine, insiders need to diversify, pay taxes, fund personal ventures, the critical missing piece is the lack of open market buying at the current price levels.
So management is not putting new capital into the stock at $213.88.
Correct. Their actions suggest that while they remain fundamentally bullish on the company's operational future, they do not view the current market price as undervalued. If the stock traded at $185, we would likely see open market purchases.
The absence of buying is a silent signal.
It's a silent signal that insiders feel the current price is full.
And we have to reiterate the governance structure here.
That 21.4% insider concentration creates a key man dynamic. And while that's beneficial for stability, it centralizes control. Minority shareholders must be aware that they have limited power to influence strategic decisions or block initiative that the Mas family strongly supports.
It ensures the company operates under a singular, consistent vision.
For better or for worse.
That dual-nature private control coupled with public trading is part of the MasTec DNA. Now let's pivot to the most crucial section, the risks that could quickly evaporate that premium valuation.
Chapter 6, Risk Assessment.
Okay, if MasTec is priced for perfection at 33 times earnings, we need to understand exactly what perfection entails and what major obstacles are standing in their way. Let's start with an internal SWOT analysis, reviewing their core strengths.
Their strengths are formidable. First, that diversified revenue base across communications, clean energy, power delivery, and pipeline. It provides a crucial hedge.
So if one segment faces a temporary recession, the others can pick up the slack.
Right. It stabilizes overall revenue. Second, their scale and superior bonding capacity are insurmountable moats for most competitors. They can bid on projects too large and complex for anyone else.
And third,
Their one-stop-shop integration model. It allows for higher margin capture and simplified supply chain management for the client.
okay, what about the internal weaknesses that could undermine the execution?
Despite the recent improvement, their margin profile still lags the industry leader. Adjusted EBITDA margins of 8% to 9% are solid, but they need to reach that 10% to 12% level consistently to justify the full premium relative to Quanta.
So there's still operational slack.
There is. Furthermore, the high working capital intensity of the business means that the rapid growth, while fantastic for revenue, puts constant, severe strain on free cash flow visibility.
Making quarterly FCF inherently lumpy and difficult for investors to predict.
Exactly.
Let's discuss external opportunities. Where is the unexpected growth coming from beyond the existing backlog?
One massive emerging opportunity is the hyperscaler direct connect model. Tech giants like Microsoft, Google, Amazon, they're building so many data centers that they are increasingly bypassing traditional utilities to build their own power infrastructure.
And MasTec is perfectly positioned to serve these cash-rich tech giants directly.
Perfectly, and often on cost-plus contracts, which minimizes MasTec's risk.
That's a powerful new customer base.
Mm.
What about future energy systems?
There is also significant future potential in the infrastructure for next-generation energy systems, specifically civil construction opportunities related to the deployment of small modular reactors, or SMRs.
Which will need specialized site prep and grid connection.
Right. And finally, climate resilience continues to drive secular growth in high-margin emergency restoration services. As extreme weather events increase, the demand for MasTec's quick response, premium rate service crews will only intensify.
Okay, now for the threats. What macro or geopolitical factors could seize up that $16.8 billion backlog and just derail the momentum?
The biggest immediate threat is regulatory, permitting gridlock.
Right.
MasTec has the signed contracts, but those projects can't move dirt until they receive federal and local approval. If the federal government fails to streamline NEPA reviews, that $16.8 billion in contracted work remains stuck on paper.
Which leads to crew idling, equipment sitting unused.
And a crushing drop in asset utilization, which immediately destroys quarterly profitability.
And second, the cost of capital.
The threat of higher for longer interest rates remains a persistent headwind. MasTec's clients, especially renewable energy developers, rely heavily on debt financing.
So if high interest rates persist, the return on new projects can collapse.
It can, causing customers to cancel projects even if they are in the backlog. Draining the backlog through cancellation is the fastest way to shrink MasTec's future revenue profile.
Now, let's expand on the crucial, specific operational threat you flagged, the tariffs of 2025. This risk is complex because it seems like MasTec should be insulated.
This is the ultimate downside risk right now, and it requires detailed explanation. The U.S. administration has imposed severe 25% tariffs on imported steel and aluminum, and there are serious considerations for new duties on solar components.
And these materials are the structural core of MasTec's work pipelines, towers, solar farms.
A very core.
But MasTec uses pass-through contracts, right? Meaning they push the material cost increase onto the client.
Yeah.
So why is this a severe threat to MasTec's bottom line?
Because the ultimate risk is demand destruction, not cost absorption.
Okay, explain that.
If tariffs make a $500 million wind farm project 20% more expensive, the developer may look at the high cost and the diminished return and just cancel the project entirely.
The project's viability disappears.
It disappears. And if projects are canceled, MasTec's crews are idled, utilization rates collapse, and the company has to absorb the fixed costs of maintaining those crews and equipment with no revenue coming in.
And beyond that, trade disputes just introduce supply chain chaos.
Exactly. It's not just the cost, it's the availability. If the supply chain for specialized steel or high-efficiency solar modules is disrupted by duties, the material simply may not arrive on site.
Which forces MasTec to stand down expensive crews, no matter how robust their contract terms are.
It leads to massive operational inefficiency and crushes the high-margin execution they're promising the market. This is why we view the tariff threat as a major systemic risk.
We've covered the convergence of growth drivers and the major internal and external threats. It's time for the final synthesis.
Chapter 7, Conclusion.
Okay, let's synthesize all these findings. What is the most powerful case for MasTec being a generational compounder?
The bull case rests on the inevitability of the infrastructure supercycle. The need to power AI, harden the grid, and deploy renewables it's a non-negotiable societal demand.
Right.
MasTec, with its massive scale, superior bonding capacity, and integrated one-stop shop model, is perfectly positioned to capture this demand. The accelerating revenue growth, 14% organic, and the demonstrated margin expansion, that 9.4% EBITDA, validates that management has successfully executed the turnaround.
And is now compounding earnings effectively within a favorable long-term environment.
That's the bull case.
Okay, so what are the primary justifications for the bear case? The reasons an investor should be cautious.
The bear case hinges on valuation and macro volatility. At 33 times forward earnings, MasTec is priced for perfection, leaving absolutely no room for error.
The risk of cyclicality is still there.
It's high, and it's amplified by external threats like permitting gridlock, and most acutely, that geopolitical tariff threat, which poses a substantial risk of demand destruction. It could rapidly drain the massive backlog.
And any return to execution failure, like we saw in 2023, would trigger a severe multiple contraction.
It would.
Let's restate the valuation summary we established through our deep dive.
Okay, our severe bear case, triggered by a recession coupled with a major execution stumble, puts the price around $150 per share. Our base case, from the rigorous DCF model assuming 12% FCF growth, lands between $185 and $200.
And the analyst bull case consensus.
That suggests a high target near $248.50.
So given the current price of $213.88, which is above our $185 base case valuation, what is the final neutral verdict for the disciplined value investor?
MasTec, Inc. is undeniably a high-quality industrial compounder, led by an experienced family management team capitalizing on historic tailwinds.
Yeah.
However, at $213.88, it is trading at a full price above our calculated intrinsic value. This requires the company to deliver flawless execution and continuous margin expansion to generate further alpha for new buyers.
So what is the most prudent strategy for a listener who recognizes the quality of the business but respects the need for a margin of safety?
For a disciplined value investor, the stock is a hold. We admire the business, but we have to respect the valuation. The prudent strategy is to keep MasTec on the watch list and wait patiently for a market pullback.
And a position should only be initiated when the stock approaches that $185 level.
Right. Maybe triggered by tariff-related headlines, a temporary quarterly earnings variance, or just general market volatility. Buying closer to that intrinsic value provides the essential margin of safety for a long-term position in this compounder.
If you enjoyed this deep dive into MasTec Inc. and you want more rigorous, detailed analysis like this on the biggest names in the market,
Like and subscribe to Stock Analytics AI.
for $4.999 a month, you can access hundreds of deep dive videos on the S&P 500 and the NASDAQ 100, plus submit your own stock suggestions for us to cover next.
And here is a final provocative thought for you to consider. While MasTec is currently executing a successful pivot in its pipeline segment toward hydrogen and carbon capture, leveraging its existing expertise, how rapidly might changing technology, specifically breakthroughs in decentralized power generation, like localized fuel cells or highly efficient small-scale carbon capture tech, disrupt the long-term utility and pipeline sector, adding unforeseen complexity to MasTec's current pivot strategy decades down the road.
Something to chew on as you consider the future of infrastructure. And remember, that analysis you just heard was thorough, but you need to do your own homework.
This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.